Hello, welcome to the webinar today on the landmark ruling in South Dakota versus Wayfair. What does this ruling mean for your business? This was a Supreme Court case decided about a month ago, which has had some tremendous implications in the world of sales tax. Today, there'll be three of us talking about some of the implications of this case. My name is Vinay Navani at Wilkin & Gutton Plan, and I'm joined by Len Nitty, who is a partner at Wilkin & Gutton Plan who focuses on state and local tax, as well as Megan Newby, who is a supervisor in our firm, who also devotes a big part of her practice to state and local tax matters. As you know, with the housekeeping, it's important to answer the polling questions to make sure you get CPE. So we will have some questions embedded in the presentation. The recording of this will be really available on two places. It'll be on the State Society's YouTube webpage channel, and there'll also be a link on our firm's webpage that you can see there on the third bullet. So with that, I'm going to turn this over to Len Nitty, who's going to really get us started on this groundbreaking case. Len?
Great, thank you, Vinay. And you say groundbreaking, it is very significant. It's probably the most significant ruling that we've had in at least the last 25 years, going back to Quill and maybe even back to National Bell's Hess 40 or 50 years ago. So this is groundbreaking. This is really going to impact a lot of multi-state businesses, especially the remote sellers, and that's going to be the main focus today. So we're going to get started with some background. We're going to talk a lot about National Bell's Hess and also Quill, just to set the stage for South Dakota v. Wayfair and what that ruling has done now. Meg is going to talk to us about economic nexus and other remote seller nexus standards. I'm going to talk about how this ruling may impact income tax nexus. I'm going to also talk a little bit about different types of businesses that are going to be impacted. Vinay is going to specifically take us through the technology industry, and then I'm going to talk about what may be next on the horizon for a number of these states. So get started with some background, and before we get into National Bell's Hess, I think just to understand the state's mindset is, dealing with remote sellers who haven't established nexus with the state has become a growing issue with the rise of the internet and the Amazon marketplace and all of these different types of venues where they could sell without actually creating physical nexus in a state. And this creates a major challenge for these states because they're unable to have the seller collect sales tax and turn it over to the state. Now, as CPAs, we all know that if you have a taxable transaction where the vendor doesn't collect sales tax, it becomes subject to use tax, which essentially is the mirror of sales tax, where it transfers from the seller needing to collect it to the buyer needing to self-report and pay it over to the tax. But Vinay, practically speaking, how many taxpayers do you see comply with use tax laws?
I can probably count the number I've seen on one hand in my career.
Yeah, certainly when it comes to individuals.
Correct. Businesses are a different story.
Yeah, businesses is maybe 50-50. A lot of the more sophisticated businesses do a good job of assessing use tax, but the state knows there's a lot of businesses, and all the states know there's a lot of businesses that do not do a good job self-assessing use tax. And quite honestly, when one of these states examines a business or audits a business, they usually spend a little time looking at the income tax issues, little time looking at payroll, and then they settle in for the longest portion of their audit to be focused on use tax, sales and use tax, because they know there's a lot of exposure there for most of these businesses. I know that's where they get the most bang for their buck. So unfortunately for the states, they don't have the ability to audit every taxpayer and comply there and make sure that they're in compliance. So what they tend to do is they look for new and aggressive ways to require that the sellers have to collect sales and use tax. And that's kind of a lot of what the focus is going to be on today. So to give some background, going back to a 1967 ruling, National Bell's Hess Inc. versus Department of Revenue of Illinois, was the first real big state and local case dealing with remote sellers and sales tax. National Bells Hess was a mail order company located in Missouri, had no property employees in Illinois, and no direct advertising in Illinois except for mailing of catalogs into the company or into the state. All catalogs and products are shipped via common carrier from outside of Illinois. And what Illinois had done is Illinois amended their law to change the definition of who a retailer is who would be subject to sales tax, or who would be required to collect sales tax. And they amended their retailer definition to include engaging in soliciting orders from users by means of catalogs or other types of advertising as a retailer who has nexus with the state. So National Bells Hess decided to take Illinois to court and argue that they didn't have sufficient nexus with the state, despite the revised definition in Illinois' law, and this ended up going up to the Supreme Court. And it ended up really being a Commerce Clause and Due Process Clause case of the Constitution. And just to give a little background on the Commerce Clause, which is ultimately how the Supreme Court ruled, is the Commerce Clause authorizes Congress to regulate commerce among the states. It's been interpreted in tax cases to include both the authority to regulate, but also an implied prohibition of state laws that discriminate against interstate commerce. This is known as the Dormant Commerce Clause, for those of you that have heard of that before. And the Supreme Court ultimately held that the Commerce Clause prevents the state from requiring the collection of tax where the seller's only connection to the state is by common carrier or mail deliveries. So that's National Bells Hess. And we had this as our authority for quite a long time, until 1992, when Quill versus North Dakota was determined and ruled on by the Supreme Court. Quill Corp sold office equipment and supplies, and it solicited sales from a few different ways. It solicited via catalogs, flyers, advertisements, and telephone calls. Quill maintained no property employees or agents in North Dakota. And North Dakota is another state that decided to amend their retailer definition to try to capture Quill and other types of remote sellers. And what they did is they tried to establish a bright line test for creating nexus. And the way they did this was by amending the retailer definition to include every person who engages in regular or systematic solicitation of a consumer, the consumer market in the state. Regular or systematic solicitation was defined to mean 3 or more advertisements during a 12-month period. So for North Dakota, they were trying to establish a bright line of 3 solicitations within a 12-month period. So Quill took North Dakota to court, and at the trial court level, the trial court actually ruled in favor of Quill based on National Bells Hess. North Dakota appealed that to the state Supreme Court, and what the North Dakota Supreme Court decided was that National Bells Hess was outdated and obsolete, and they ruled in favor of North Dakota. So Quill took this up to the Supreme Court, and the Supreme Court agreed to hear it. And, this really ended up focusing more on the due process clause in their determination. And due process clause for state and local taxes has been interpreted to prohibit states from taxing a business unless there is a minimal connection between the company and the states. And what the ruling of Quill gave us was a physical nexus test. There had to be a physical nexus standard to ensure that, or to allow for a state to physically require sales tax collection of a taxpayer. And this has really been the basis of how we've done planning over the years to try to minimize how many different states a taxpayer is going to have nexus with for sales and use tax purposes. You try to avoid the physical presence and do everything remotely. And the states have had some success trying to get around Quill and find unique ways of establishing, physical presence that's beyond physically having people in the state. And Meg's going to talk a little bit about that later, so I don't want to go into too much detail. But this is where we were and continue to be until we get to South Dakota, who was one of the first states that enacted an economic nexus law. And what South Dakota did was they passed this economic nexus threshold, which creates a bright line for determining based on your economic activity in the state, creating a requirement to collect and remit sales and use tax. And Meg's going to get into some of the nuts and bolts of this in a few minutes. And on top of that, what South Dakota did is they notified four the larger online retailers, internet retailers, of their obligation to collect and remit sales and use tax. Wayfair, which is the one that the case is titled, was one of them. Overstock.com, Newegg, and Systemax were all the four retailers that were contacted. Of these four, only Systemax decided to willingly comply with South Dakota's sales and new sales tax law and economic nexus standard. The other three declined to comply, citing Quill and physical presence, the physical presence test under Quill, and stated that South Dakota had no authority here to require them to comply with sales tax collection. So South Dakota, in turn, sued these three companies to enforce sales tax collection. And all of the South Dakota courts decided to rule against South Dakota, citing that they did not have the precedent to overturn either National Balance, Hess, or Quill. So South Dakota appeals to the U.S. Supreme Court, and the U.S. Supreme Court decided to hear the case. The first state and local case for sales tax that was heard in quite some time. So what was surprising to a lot of practitioners is that the U.S. Supreme Court ruled that the physical presence rules of Quill was incorrect. And what was interesting in the earlier two cases we discussed, the court was very clear that they felt that Congress needed to act in order to regulate interstate commerce here. And it was almost expected that the Supreme Court here may do the same thing and point to Congress once again to pass some level of interstate commerce type of legislation, especially for sales tax nexus and also an income tax nexus. But the court, went ahead and ruled that, the ruling in Quill was incorrect. It overturned both the rulings in Quill Court versus North Dakota, as well as National Balance Hess versus Illinois. The one thing the court did not do is it did not opine on the constitutionality of the South Dakota Economic Nexus statute. It has remanded those back down to the state courts to determine it. I think it is widely expected that the state tax courts will approve this economic nexus principle. And what we've been seeing already, and Meg will talk a little bit more about this, is states are now going to start pretty quickly passing economic nexus statutes, probably very similar to South Dakota's, just to kind of jump on the wave and make sure that they're collecting all the revenue possible from sales and use tax. So that brings us to our first polling question, which is, how do you think the Wayfair ruling will impact either your business or your clients' businesses? Positively, negatively? Are you unsure at this point, or do you think it's not applicable?
And Lynn, while we're waiting for that, I believe in the Supreme Court opinion, they spoke favorably about some of the de minimis threshold South Dakota had in the statute, right, to make it easier to comply with. Correct.
Yeah, they looked towards a number of different things, although it wasn't ultimately how they ruled, but they did look and discuss, the bright line threshold not necessarily being too low. They liked that. They also looked at South Dakota as a streamlined sales tax state and thought that South Dakota was trying to manage and make it easier to comply with these laws by participating in streamlined sales tax. I don't know that would necessarily be applicable in a non-streamlined sales tax state trying to assert economic nexus, but I guess that'll be determined down the road should we see a challenge to any of these laws in the future.
Right, but I think it all goes to explain why most people think that the statute in South Dakota will be upheld by the South Dakota Supreme Court.
Agreed. So I think we have enough in, and nobody thought this was going to positively impact their business, not surprisingly, and the vast majority is either think it's going to impact them negatively or they're unsure about it, which I think is pretty fair right now.
So Len, that tells me that we don't have any accountants with a lot of brick and mortar retailers who had felt that they were competitive disadvantage on the
Yep,
webinar.
we'll talk a little more about that later in the presentation, but yes. So I'm going to turn it over to Meg now to tell us all about economic nexus.
All right, thanks, Glenn. So despite being in stark opposition to QUIL, the former law of the land with regards to sales tax, economic nexus is not an idea that has emerged overnight since the Wayfair ruling and has actually been on the horizon for many states for the past few years. So economic nexus, which does not require physical presence in a state, instead creates a bright line test for tax obligations by establishing sales and volume thresholds. For sales tax purposes, remote sellers are required to collect and remit once they hit either a certain dollar threshold or a number of sales transactions in either a calendar year or rolling 12-month period. South Dakota, whose economic nexus standard is now in the limelight, requires out-of-state sellers to collect and remit sales tax once they achieve either $100,000 of in-state annual sales or 200 separate in-state sale transactions during the year. Although the sales component may seem reasonable enough, it's important to note that volume does not take into account the per transaction cost. What I mean by this is, let's say a company selling $5 widgets, 200 transactions may only result in about $1,000 of in-state sales, which is far less substantial than the $100,000 sales threshold in effect. For purposes of this webinar, we chose to examine the economic nexus standards for New Jersey and our neighboring states, New York and Pennsylvania, as well as the two key states of California and Texas. New Jersey is actually one of the few states that has passed legislation regarding economic nexus for sales tax purposes within the past 5 weeks since the Wayfair case was decided on June 21st. Since this is a relatively recent development, it likely comes as no surprise that New Jersey set the same thresholds as South Dakota. Economic nexus in New Jersey, which will be effective as of October 1st of this year. Pennsylvania, on the other hand, has no volume threshold and a much lower sales threshold of a mere $10,000. However, it's important to note that Pennsylvania's economic nexus is a notice and reporting law, which allows remote sellers to make an election to either collect and remit sales tax on Pennsylvania sales or to comply with the state's rigorous notice and reporting requirements. Although the specifics of notice and reporting requirements do vary slightly among states, in general, these notice and reporting requirements require the remote seller to do the following. 1, to include a notice on their website that use tax may be due on purchases. 2, to include a transactional notice with each sale informing customers that use tax may be due. 3, to send an annual notice to customers who spent more than a certain amount, reminding them that they owe use tax. And 4, send an annual notice to the state reporting information about the sellers who owe use tax. Needless to say, states have intentionally made this notice and reporting process difficult in order to encourage retailers to back down and opt to collect and remit sales tax. Although the primary focus of this webinar is sales tax, we did want to mention that a handful of states also have economic nexus standards which they apply to income tax. California, for instance, requires corporations to file an income tax return if greater than 25% of their total sales are from California customers, or if the corporation had California sales in excess of a certain threshold amount for that particular tax year. For 2017, the threshold was just shy of $592,000, which has been indexed for inflation since 2011. Another example is New York, which requires corporations to file an income tax return if the corporation has an excess of $1 million of New York sales during the year. So in order to illustrate just how prevalent economic nexus is, we have included each state that has enacted economic nexus for sales tax purposes. You may notice that of the 26 states that currently have specific economic nexus standards, the majority have the same thresholds as South Dakota. However, it is important to note that there are a handful of states with more lenient thresholds and a few states that have stricter thresholds that coincide with the notice and reporting requirements that we just discussed a few minutes ago. Not only that, but the effective dates do vary from state to state as well. Like I mentioned on the last slide, New Jersey's economic nexus is effective as of October 1st of this year, while some states have effective dates that predate the Wayfair case. Since each state has different stance with regards to economic nexus for sales tax purposes, it is important to understand the nuances of the states that your business does not have a physical presence in, but may still have a sufficient enough connection to. So even before Quill was overturned and physical presence was no longer a requirement for a state to subject a business's receipts to sales tax, many states had implemented clever standards in order to compel remote sellers to collect and remit. Although a business itself may not have a physical presence in a certain state, the physical presence of an affiliate of the business or affiliate nexus is sufficient enough to subject the business to sales tax. Click-through nexus enables a state to impose sales tax on a remote seller who contracts with an in-state individual or company who either indirectly or directly refers potential customers to the retailer through a link on the contractor's website for either a commission or some other form of consideration which is paid upon the sale. You may have heard of click-through nexus referred to as the Amazon law. Cookie nexus refers to internet cookies, which are small pieces of data sent from a website and stored on a user's computer that record the user's browsing history. When you make an online purchase, cookies are why you start to see similar products advertised on different websites that you visit after the sale. Remote sellers who install cookies on an in-state user's computer are viewed as having nexus with that specific state. Marketplaces such as Amazon and Etsy are required to collect and remit sales tax as the retailer in states where the marketplace has a physical presence, rather than the requirement being imposed on the individual sellers. Trailing nexus is a method used by some states under which businesses that cease the activities that create a nexus with the state, whether that is economic or otherwise, continue to have a tax obligation after those activities have ended. Trailing nexus periods range from 3 months to 4 years, depending on the state. Use tax notice and reporting requirements were discussed previously, but just as a reminder, are typically elected by a remote seller in lieu of collecting and remitting sales tax in a specific state. And with that, we're at another polling question. So how do you think that states that currently do not have economic nexus standards for sales tax will react to the Wayfair decision? Do you think they're going to implement the same threshold as South Dakota? You're going to implement a higher, more lenient threshold than South Dakota? Implementing a lower, stricter threshold than South Dakota? Or are you still unsure? So it seems like everybody kind of has the same view of this as we do here at Wilkin and Gutton Plan. So we're going to close this poll. It looks like everybody has pretty much already responded. But we're inclined to agree. Like our own state of New Jersey decided, they're going to stick with the same thresholds as South Dakota. But of course, any state is able to make their own decision. Could be higher, could be lower, we're not sure. And with that, I'm going to turn it back to Len.
Thanks, Meg. So how may this impact income tax nexus? First thing to be clear about, this ruling was purely a sales and use tax case based on sales and use tax economic nexus laws. That said, several states have already enacted economic nexus laws, including California and New York, I believe. And, you know, one thing that these states have been very careful of it as they've enacted economic nexus laws is that they've continued to provide Public Law 86-272 protection in those laws. So what does 86-272 protect? It protects the mere solicitation of sales within the state of sales of tangible personal property within one state where the sale is shipped back out of state to the home base to be approved and fulfilled from out of state. So all the activities that are happening in that state are the mere solicitation. And if that's all you're doing in the state, you have Public Aid Law -272 protection. That said, it's only for tangible personal property sales. So that's not going to include any services that are being performed. It's not going to include anything that rises above the level of selling tangible personal property, such as if one of your salesmen is collecting checks from one of their customers, taking returns from one of their customers. Vinay, what's your experience been on a taxpayer's ability to qualify under Public Law 86-272, even if they've tried to structure it perfectly to comply with the law?
I think in my career I've had one where I really felt comfortable that they met the threshold, because the bar is set so low that just in the course of a salesperson's day-to-day activity, whether it be accepting a check, doing a demo, accepting a return, doing product training, it's so easy to violate that strict standard that it's almost unheard of to qualify. People talk about it a lot, but I think in practice it's not a practical alternative.
Yeah, and while I've asserted and been successful more than one time, as you've seen in your career, it has become more challenging, especially as a company's dealing with more and more, salesmen. It's difficult to keep tabs on exactly what they're doing and educating the salesman every time they come in. It's very easy for some level of activity the salesman's conducting that the business may not even understand is happening to trip the line on Public Law 86-272. But as of now, we still have Public Law 86-272. You can still use it as a planning opportunity to limit your income tax nexus. But keep in mind, again, it only applies to sales of tangible personal property. States that have not been in favor of Public Law 86-272 have tried to find some ways to get around it. One way is, franchise taxes. Texas is a state that has franchise taxes, which are taxes measured based on some other method other than net income. You have other types of taxes, like Washington State and Ohio have gross receipts taxes. Pennsylvania used to have that capital stock tax. So there's a lot of different ways that states have gotten around Public Law 86-272 by taxing taxpayers on something other than an income tax. And, with this ruling in Quill, perhaps it sets the stage for states to look to challenge the relevance of Public Law 86-272 in the current, marketplace, where so many sellers are now online, selling online, selling remotely. They may think it's time to revisit 86-272 or even try to claim it's outdated or irrelevant now. So we'll have to see if that happens down the road. But to date, with the states that have passed economic nexus laws, they have continued to respect the Public Law 86-272 language. So what about impacted businesses? Clearly, this is going to have a huge impact on internet and remote sellers, especially the larger ones that are meeting these thresholds, where, perhaps a seller that just had one location in New Jersey, but sells into 50 different states, they may have just seen their sales tax compliance go from having to collect New Jersey tax to having to collect tax potentially in 50 different state-level jurisdictions, plus all the localities that collect sales tax. I think last count we're over 12,000 jurisdictions within the United States that have a sales or use tax. So it is, going to be quite difficult on these remote sellers and internet companies to comply here. Who else is going to be impacted? Service providers are going to be impacted, even if all this work's being done out of state, because sales tax is, generally speaking, a destination state tax. So where is the seller going to, or where's the purchaser going to receive benefit from it? That is where the sale would be subject to sales tax. So if you have repair and maintenance types of services, and Renee's going to talk a lot about technology in a bit, but the technology industry may be significantly impacted by this ruling from a sales and use tax perspective. It's not doom and gloom for everyone, and I think we've probably even heard a few brick and mortar stores actually exhale and cheer at this ruling, because they've been challenged over the years since the rise of the internet and remote sellers, because a lot of consumers think, well, hey, if I go into my brick and mortar store, I'm actually being penalized by having to pay sales and use tax, because if I buy it online, it's free of sales and use tax, and I never have to pay that again. We as professionals know that there's still a use tax component that they're responsible for, but as Vinay said earlier when asked the question, individuals tend not to comply with use tax, and it creates a big black hole for the states, and was really a competitive disadvantage for these brick and mortar stores, especially with online and remote sellers offering free shipping now. You know, even some of them are even offering same-day delivery now. So it's just such a convenience to order online. And if a consumer is willing to wait a few days, they always felt that they were getting something for less money because they didn't have to pay the sales tax. So now it kind of levels the playing field for these brick and mortar stores, and perhaps, you know, the brick and mortar stores will see an uptick in sales as a result of this.
Right, but you know, the other side to that trend is just looking at Amazon. As Amazon is, their footprint is widened so much, they are physically in lots of states, and I think Amazon has said that they were charging sales tax, at least for the goods sold through Amazon itself, not through the third-party sellers, because of their physical presence all over the place. So, so some of the major players are charging sales tax, but obviously a big company like Wayfair, which is a huge internet retailer, was not charging sales tax.
Right, in a lot of states. It's not so much an issue in New Jersey because they both have physical presence in New Jersey. Yes. But in many states they don't have any physical presence. So those sellers, when they're selling in those states, there was never a collection of sales and use tax. So it's been a big issue. I know in New Jersey alone, and when they passed the budget, they estimated the passing economic nexus was going to create about $180 million annually of revenue, additional revenue for the state. And quite honestly, that's probably what allowed us to not have a government shutdown, is that this revenue, this unexpected revenue, unfortunately New Jersey was quick enough to act, and the timing of the ruling was almost perfect considering the timing of passing the New Jersey budget. But it probably created us from having a shutdown because the governor and our legislature was so far apart on whether to raise taxes on individuals or businesses or how they were going to bridge that gap. I think this made it a lot easier to get the budget passed and allow business to continue as usual for the state.
Right. We still had a few small tax increases, but
right.
There was no shutdown.
No shutdown. So I think we're now going to turn it over to Vinay to talk about the impact on the technology industry.
All right. Thanks, Len. So, you know, we've been talking a lot about online retailers and how this ruling is important because of the physical presence aspect, but technology is just another huge segment that kind of thrives due to electronics and the fact that there is no physical presence. So we're going to spend a little bit of time talking about how the Wayfair case impacts different aspects of the technology industry. So let's just kind of talk about the types of products we're going to talk about. We're going to talk about cloud-based services, which there's three main types: software as a service, platform as a service, infrastructure as a service. That's one group of services. The next, we're going to talk about data processing services, and then we're going to talk about traditional software and how the Wayfair case impacts all these. So before we get into the taxation of the cloud-based services, let's just talk about the three types of cloud-based services so that we all have the same reference point. So the most common, and where we're going to spend our time today, is on software as a service. So these are things that we all use every day. Gmail, this webinar service we're using right now. Your tax software is most likely a software as a service, something where you're not maintaining the software in your office. You're logging in, and somebody else is taking care of all that back-end headaches. And you're just simply paying usually a periodic subscription fee to use the service. That's by far the most common aspect. Not that we're going to talk about it in too much detail in terms of sales tax, but just recognize that there's another type of platform or cloud-based service called platform as a service. And these are really things that you would use if you were a developer of software. These are the underlying programming languages that allow you to write apps, to build databases, things like that. And I want to point out this as well as the next, in case you're dealing with software or platform as a service or the next category, understand that there's separate rules with respect to sales tax that apply, and you need to look at those separately. And then the last major piece is what we call infrastructure as a service. And this is really, it's as if you went out to a computer store and rented a server, except you're doing it online. You're going to Amazon Web Services and you're saying, I need 10 gigabytes of computing space, and you pay for it as you need it. So again, as a user, you typically would not use something like that. You're going to be in some sort of IT function hosting something. And again, different rules. So let's go back to our main focus of software as a service and our 5 representative states that we're dealing with for purposes of this webinar. So who subjects software as a service to sales tax? So as you can see, New York is a big one. New York, Pennsylvania, Texas do. California, New Jersey do not. Now, the question will often come, okay, I've got a customer I'm selling software as a service. Do I look to where my customer is located, who's got the contract, or where the software is being accessed from? So I could be a New Jersey company with a SaaS product. I could have a contract with a New York customer who's paying my fee, but that New York customer may have a remote worker who's logging in from California. So it's a great question. I get asked all the time. I don't have a really good answer other than I think the practical approach is you typically look to the contract of where your customer is. Because many of my clients will say, look, I know who I've got my contract with. They're the New York customer. I really have no easy way to figure out where are they accessing the software from. And it's just impractical for me to try to look at IP addresses and saying, where are people logging into the software from? So I think as a practical matter, we look to where the customer is, and we look to see, okay, well, first we look to see, does that other state charge subject SaaS to tax? Then we would look to see, does that state have an economic nexus requirement, assuming that we don't have a physical presence in the state. And then if we do have a customer in one of those states, then we probably should be collecting sales tax on our periodic SaaS subscription fee. So now let's go to the income tax side of the column. You know, how do states look at software as a service? Well, I mean, states are going to, because as the SaaS company you're getting revenue, it's going to be subject to income tax. The question is where. So one of the common dilemmas we've had, which is going to be corrected next year, is the difference in how New Jersey and New York look at sourcing rules. So if I'm a New Jersey-based software company and I'm producing a SaaS product, New Jersey for this year says that we look to where the service is performed. If all my developers and code writers and servers are sitting in New Jersey says that's a New Jersey sale.
Right, for corporate tax purposes.
For corporate tax purposes, correct. For New York corporate tax purposes, New York says, well, where are your customers? If the customer is accessing that SaaS product or sitting in New York, that's a New York-based sale. So you have 2 different states that are taking the same bucket of revenue and subjecting it to tax in their state. Fortunately, in 2019, New Jersey is going to a market-based sourcing approach, which I think tends to be the majority of the states. But as you can see, Texas still uses a cost of performance, and there's plenty of other states that we've not listed here that use cost of performance when it comes to income tax. So again, you want to look to see, does the state have an economic nexus statute? And if they do, you know, you could have situations where the same income is being subject to tax twice, or if you're lucky, it could be the opposite, where you could have an item of income that's not being subject to either state, the cost of performance state or the market-based sourcing state, depending on how the rules work.
Yeah, and certainly the trend in state and local taxation is to go with market-based sourcing, because the states want to shift the tax burden to those who have a physical presence in the state and are creating jobs to the out-of-state companies that are just taking advantage of their economy.
Of course. Yep. So now let's look at the other category called data processing services. And you can see the definition there on the screen. to me, the example is the easiest way to comprehend this. So we have a client that is the kind of the intermediary between online travel agencies where you go to look for a hotel reservation and the hotels themselves to share their capacity to the online travel agencies. So think of it as like an electronic switch or an electronic connector. That's what this company does. And for sales tax purposes, they are a typical what we call data processing company, which is really separate from SaaS, separate from software. They provide data processing services. And if we look to our states, most states do not impose sales tax and data processing services except for Texas. Texas, as you might know, does not have a personal income tax, so it kind of makes sense that they tend to have a more dynamic sales tax regime. So some states will tax data processing services, and then you have to look at the income taxation, and again, you have market-based states and cost performance states. So again, you can have good news, which a piece of income could be taxed in neither state, or bad news where it's taxed in 2 states. But data processing services is something to keep your eyes on. And then finally, let's go to software. This is kind of the original technology product. I think we all know what software is. Software has changed over the years. Years ago, when you wanted Microsoft Office, you would go to Staples, you would buy a CD-ROM, and you would load it on your computer. There was something tangible. And most states took the position that when the software is being delivered on a tangible medium, it was tangible property, because sales tax was really developed in the world before we became a services economy. And not that it made a whole lot of sense, but most states took the position that if you could touch the software on a CD, it was subject to sales tax, whereas if it were being downloaded and you couldn't touch it, it was not subject to sales tax. So now that's kind of evolved over the years, and going back to our 5 states, you can see the different positions states take on sales tax. So most all states will say, if it's delivered on tangible personal property and CAN software, meaning pre-programmed, you don't need any customization like Microsoft Office, it's going to be subject to sales tax. When you have software downloaded, over the years, most states have now taken the position that yes, that is also subject to sales tax, because it's become the norm in delivering a software. Most states take the position that customized software is more like a service and is not subject to sales tax. But as you can see, Texas does in some cases, Texas and Pennsylvania in some cases do tax customization. In both of those cases, it's customizations of CAN software. So if I had QuickBooks and I hired a programmer to write an interface between QuickBooks and interface between another piece of software that wasn't compatible with QuickBooks, that service may be subject to sales tax in Pennsylvania and Texas. On the income tax side, you still have the same issue about cost of performance, or where the user is getting the benefit, the equivalent of market sourcing, meaning the destination state method. So again, you need to look at, does the state you're dealing with have an economic nexus statute? Does it tax the type of software you're delivering, to determine if you should be subjecting that sale to software? And that takes us to a polling question. Which area of taxation do you think provides taxpayers in the tax industry with the greatest level of uncertainty? If the product is subject to sales tax, I think we have a typo there. If they have nexus, how to source their receipts, or unsure. So let us know what you think. I was just told there wasn't a typo. So, in any event, most people have responded. Let's give it another second. People to jump in. And I think with that, we'll close the poll. Yes, most people believe that nexus is the biggest issue, whether they're going to be subject to, if they have clients in the tech industry, how that's going to impact them. And there you see the final results. So now we go to Len to kind of take us into the wind down and think about the future steps.
Great, thank you, Vinay. And technology is always interesting because so many more businesses are having a technological component to the way they do business, more and more every year. So you may capture non-traditional technology companies here who are just providing information on their website, offering downloads, whatever it may be. So I think a lot of businesses have to keep this in mind as their business model evolves over time as well. Do you agree?
I agree, absolutely. Absolutely.
So what's next? I think the easy one is the first bullet over here, and many states are going to start to pass copycat legislation. We've already seen it with 5 states, New Jersey and Wisconsin being the first 2, and they've been joined by 3 other states. So within a month's time, 5 additional states have passed economic nexus laws, and now I think we're at a point where more than half of the states have economic nexus for sales and use tax purposes. And it's just going to continue to trend in this upward direction. And I think we're going to see a lot of activity in this area over the next year, especially as states get into passing their annual budgets and are looking for new ways to generate and create tax revenue. This is going to be a no-brainer for most of them that don't have an economic nexus already in place. So what about the cost complexity of compliance for taxpayers now? It's certainly going to rise, especially if you had a business that was really only focused in a few different states, needing to collect sales and use tax, and that's going to grow substantially now. They have some decisions to make. I think it all should start with considering, doing a nexus study and reviewing what their nexus is in each state, and there's a few different steps to that. First, looking at the states where they have new economic nexus laws, do they have a significant enough amount of business in those states to have to comply? That's step 1. Step 2, is the product or service that they're selling into those states actually taxable? One thing that a lot of wholesalers are going to rely upon is resale certificates. So at a minimum, business owners, if they're selling to retailers who are going to resell this, they're going to want to make sure that each state they're selling into offers a resale exemption, most do, if not all, and make sure that they have those resale certificates on file. Start proactively asking for them now. They really should be looking to have resale certificates on file for anyone that they're selling to that's going to be a reseller, in anticipation that they may have nexus in a lot of these different states. So I think that's an easy first step and a no-brainer. But once they go through and figure out if 1, they have nexus, and 2, if they are selling taxable products or services, then you get to, well, what are you going to do next? Can we proactively register and just deal with this on a going forward basis? Or are we in some states that had already issued economic nexus laws and we were kind of waiting to see what happened with this Wayfair ruling before complying? We may have to look at that state as trying to impose retroactive compliance. Or maybe some states may take the position that their laws have always allowed for economic nexus and really try to go back in time to collect taxes. Hopefully that doesn't happen. I don't think the courts would view very favorably on a state trying to go back and aggressively collect taxes outside of those states perhaps that already had economic nexus laws. So if a taxpayer is in that position, are you going to want to try to do something under amnesty if you have a state offering amnesty for sales and use tax purposes when they, in reaction to this Wayfair ruling? Or perhaps some taxpayers, look to voluntary disclosure agreements, and voluntary disclosure agreements are a great vehicle for limiting risk. Typically, there's a 3 or 4 year look-back period, so you're dealing with only a very small window of opportunity where the state could come back and look at you. They'll close all the years prior to that, and they'll also typically waive penalties, and some states will even give favorable interest rates. I know Texas just went through a amnesty, but I think voluntary disclosure will still be on the table for them. New Jersey has an amnesty program coming up. So it's worth looking at seeing what all the states are doing and how, these taxpayers may need to comply. But just general compliance, it's going to be costly, especially if you're dealing with 50 different states. You're going to have to get some level of sophisticated software like an Avalara or a Vertex in place that'll work with your POS system and integrate with your accounting system to charge sales tax, charge the right sales tax based on the actual state and locality that you're sending into, collect it, post it to your journal entry, and make sure that these returns are getting filed. Other taxpayers that don't want to go through that process may actually need to hire somebody to deal with this new reporting requirements that taxpayers are going to be faced. Vinay, did you have
I was just going to say that, Wayfair aside, this is really a kind of a golden opportunity to take a fresh look at all your clients' state and local compliance and do VDAs, because it's on the top of everybody's mind. It's a good time to just look for things that you thought you may have addressed years ago, and over time, the business model changes and nobody picks up the phone and calls the CPA every time they do something a little bit different, and then you wake up 5-10 years later and you have a very different business model than you might have thought in your mind. So use this as an opportunity.
Right. Not only to look at economic nexus, but all types of nexus, perhaps, for both sales and use and income tax. So I think the other thing, which isn't on the slide, that we're going to have to monitor and keep an eye on is how are states going to react on the income tax side? Are they going to start to pass more economic nexus laws on the income tax side to coincide with what they're doing on the sales tax side? That may not happen as immediately as the sales tax legislation is going to be passed by the various states, but it's something to keep an eye on and make sure we're monitoring that as well. And certainly keep an eye on to see if any states choose to challenge Public Law 86-272. I think that's another important aspect. If we lose Public Law 86-272 protection, that kind of opens up the states to go after all taxpayers for income tax purposes, in addition to sales tax compliance. So I think that brings us to the end of the prepared information. So, Vinay, are there any questions? Or I apologize, but we do have one additional polling question, and then we'll get into questions and answers. So, kind of ask this again in a different way now that we're at the end of the presentation. But do you expect sales tax nexus? Do you expect for either your business, if you're in private industry, or for your clients to have sales tax nexus in additional states due to these new economic nexus laws? So, yes, no, unsure, or not applicable.
And I think we have most of the people who have responded. I think why don't we go ahead and close the poll?
Very good. And not surprisingly, we have a pretty overwhelming yes. Most of you, and I think the three of us agree that a lot of taxpayers are going to be impacted by this and have nexus in a lot of different states as a result of economic nexus laws.
Good. We have a few minutes left. I see one or two questions in the chat box. Maybe we'll try to address them. One of them is kind of more technology focused. If we have a reseller of hardware and software, no internet sales, office only in one state, salespeople travel to make the sale, programmers do not go on site most of the time, how will this change affect us? So let's kind of talk this through. Let's just focus on the hardware component. If I am a reseller of hardware into a state, I think now that regardless of whether there's salespeople that physically go to the state, now I'm acting as similar to an Amazon. My guess is that I will be having to charge sales tax on that sale of hardware, absent assuming that the end client is not reselling it or using it in some sort of exempt function that cannot give you a resale certificate. On the software side, we need to look at what's the nature of the software being sold. Is it canned software that's being preloaded on the machine? Is it custom software being written specifically for that, that application will determine how the software is treated. And if you have a situation where you have two different results, one for the software, one for the hardware, you may have to separately treat those transactions, separately invoice them, so that you can only charge sales tax on what you're required to charge sales tax, because I think most states will say that if you bundle it with something else and there's a taxable piece of it, the whole thing is subject to sales tax. So, Len, do you have any other thoughts?
No, I think strictly on the question of how it's going to impact them, I don't think Wayfair is going to impact this business much at all, because the salespeople traveling into the states would have created physical presence to begin with, so they would have already had sales and use tax nexus. So I don't think Wayfair changes anything in and of itself, but as you say, to the extent that they're selling software to a reseller or selling hardware to a reseller, make sure you get those exemption certificates, because those will become very important to have on file.
Okay. So the next question I'm going to give you, Len, because I don't know the answer. How do we advise clients who may not reach the 100,000 threshold or 200 transactions at the beginning of the year in terms of with respect to collecting sales tax? Just in general, you start the year, you have a small presence in a state, you don't know whether you're going to hit the threshold or not.
Right. So I think they have to make a business decision. And I've heard things all over the map as to how businesses may want to deal with this. Some businesses are trying to be proactive and limit their sales in any state and kind of take a cutoff approach. Once you get to a certain threshold, to stop taking sales to avoid this, sales tax compliance requirement. But, practically speaking, is that a smart business approach? I don't know that it is. Certainly a business owner isn't going to turn down a large sale that would put them over the threshold just because of the profit they can make. So if they take that approach, they may start to impact their profitability if they end up getting thrown over that threshold anyway. But, the question is, if they collect it and don't reach the threshold, there's no harm in complying if you think you're going to get there, even if you don't have the nexus requirement. You could always be on the safe side, register to collect and remit sales tax. If you're close to the threshold and you just don't want to have to worry about, when are you going to cross that bright line, there's no harm in doing that. I think that's a good way to do it, especially if you're using some level of software that can easily track and help with the filings.
Right. So there's no harm among us tax people, but on the sales side, they're going to say, you're putting me at a commercial disadvantage because my competitors are not charging sales tax. I don't want to charge sales tax unless I absolutely have to. And I guess the other angle to this is each state's going to have their own administrative rules about how they implement this. And it could be that, it's only on sales subsequent to that you have to collect and remit. So it may be something you just have to actively monitor and have the registration forms ready to file and be ready to flip the switch if you do cross that threshold during the year.
Right, exactly. And as you said, it's not a one-size-fits-all answer because each state's going to have their own unique rules. Many of them may look just to the prior year, and when you cross the threshold in the prior year, you're subject to it in the following year. Some may make you subject to it the moment you trip the wire, as you said. So you do have to monitor, and it's hard to give a definitive answer for that question. It's more a state-specific question.
Okay. So that takes us to the top of the hour. We would like to thank you for joining us for this webinar and thank the State Society for letting us speak. And with that, we will conclude the webinar.